Hello, investors and traders, and welcome to the weekly market report. I'm AJMonte, Chief Market Strategist with Sticky Trades. And before we get into the charts, let me first highlight the 7-point trading checklist. I talked about this last week. And on that report from last Friday, I mentioned that we are making this available to the public for free. And what I did not expect was the mad rush, and our mailbox got filled up very quickly. So let me make sure that everyone is very clear on how we are handling this moving forward. Sticky Trades has free memberships available where you may not get the trade publications that I put out because that's for paying members only. We are making this trading checklist available to folks who want to learn how to read the trading checklist. You can see here that what I do each and every week, and one of the reasons why I'm so successful with hitting those targets, is that we look at the candle charts. We look for engulfing candles, shooting stars, hanging man candles, and such. We analyze volume. We look at the 20-day moving average and how the price is diverging or converging upon that moving average. We look at gaps. We look at the oscillators here. Some of you may not know how to pronounce that, but that's stochastics right there. And the commodity channel index, which is my favorite, is very popular among our members as well. And I talk about support, resistance, and roll reversal. Now, what does that mean to someone like you who's looking to learn how to read charts? Well, it gives you a simple step-by-step process to analyze the charts and determine which way the buyers are moving or the sellers are moving. Remember, you want to follow the money, and that is where we are going. So today we're going to follow the money. We have a very interesting day looking at the charts here. So we're following the money once again. Look at the rally we had today. The Dow was up almost 400 points after a massive failure in the bond auction yesterday. Now keep that in mind because this was a disaster of an auction yesterday. In fact, Rick Santelli rated it as a D. Many are calling it a failure, an F. But look what happened. We went to a higher high, erased all the losses from yesterday, and did so on lower volume. Now I'm going to erase this line because I want to move it over to the left to show you right here is a gap fill resistance. So while on Monday we might go a little bit higher to fill that gap, I think we're coming right back down and going to be moving right to that moving average. So I am not moving that downside target of 335.77, especially when we see a negative divergence in the CCI. Let me explain that because it's one of the things on the trading checklist. While here we are seeing higher price highs, we're seeing lower highs on the CCI. That is something that I pay very close attention to. You look for positive and negative divergences that way. In fact, here is a negative divergence. See, here's the price back here that moved to a lower price while the CCI went from a low to a higher low while the price was going lower. So that was a positive divergence. We have the exact opposite happening this week. So I am keeping that downside target in place. The other thing that I want to mention, and I was talking about this today on another call this afternoon, is that we have to incorporate what's known as the summation principle. When you are confused about the signals or you see a conflict in candles such as this, what I do is I use the summation principle where you combine the opening, the high, low, and close of the past 3 days, and you form that into one candle and then read it as though it was one candle. Let me show you how that looks. Right here, let's take the opening price from the day here on Thursday. So I'm going to carry that opening price over here and draw a horizontal line. That represents the body of the candle. So there's the opening price right there. Today is the close from today's candle right there. So there is your body. Well, if we opened on Thursday at a lower price than where we closed today on Friday, is that a green or a red candle? We're going to color that green. It's a green body candle that we see right there. Now, what's missing from this equation is that we need to put the shadows in. Well, we have virtually almost no shadow on top, but I'm going to put a little dot there to represent the upside shadow. what was the low of the past 3 days? Well, on Thursday, we had the low there. So when you combine all of those, the high, low, open, and close, into a new candle, what do you have? You have a hanging man candle on a drop in volume with negative divergences on the oscillators. So that's why I am not moving from that downside target. This has nothing to do with my opinion, by the way. It has everything to do with technical analysis. Now, IWM is going to look a little bit different because we did hit the downside target here. And if you had a chance to listen to the midweek report, I did say that there was a possibility we would move lower in the week on IWM and possibly make an attempt to fill that gap. That's exactly what happened. But look what we have here. Now we have what's almost a hammer candle on lower volume. That would be bullish. But the hammer-like candle also is a bullish harami. So I'm going to be making a two-part forecast on IWM. Next week, I think we're going to go just a tad higher. Let me just do that and form an ABCD pattern. So I think we're going to bounce here. So looking at this as an ABCD, I think we'll pivot back down from C and go right back down to fill the gap down here at D. Let me just explain this to you because ABCD patterns are quite popular and very easy to find on the chart. So here's a pivot point. There's your pivot. Then it bounced, and I think we're going to get the bounce on Monday, which would form B. At which time, I think we're going to pivot lower from C. And if you're following A, B, C, D, we generally go to a lower D. See, here's an A to B, pivots up to C, pivots down to a lower D. Here's another A, B, B to C, C to lower D. They form all over the place. Look, A to B pivots, B to C pivots to a lower D. So this is the pattern that we're seeing over and over in IWM and the rest of the markets. And so that is what I'm expecting. So for next week, I think now that we hit the downside target on IWM, I think we'll go a little bit higher. Let me give you the prices there. Upside target right there on IWM for Monday and or Tuesday is 171.04. Then we're looking further out in time now. This is, remember I say, when the data box pops up, you don't care about the date, you care about the price. That November 20th in the bottom right corner is not something that I put in there. That's just what comes up when I draw the line and drop it at that point. So then I think we're going down to 164.98, which would ultimately fill that gap. So that's for IWM. If we go to the Qs, you're going to see the same thing. We have the battle going on again with that number 5 fan line. We've had that happen before. We had the failure. I think we're going to see the same repeat of what we saw back here. I think the oscillators are telling the story loud and clear. We have a negative divergence here, a negative divergence here, after a higher price from here to here. Again, I pay very close attention to those negative divergences. So I am not moving from that downside target on the QQQs. That downside target is still in place at 361.19. Remember, we have a resistance point right there that I think will hold. So hold on to your hats on Monday. Be careful, any of you bulls out there that are looking to get long, or your option traders who are looking to get long positive delta. Be very, very careful. This could be another bull trap, and I'm not looking forward to having to talk people off the cliff on that one after they bought into a long position. So next one is going to be SPY. If you take a look at this, same thing. You could use the summation principle on this one as well. I'll just draw that out for you. Opening from here, the close here. What do we have? A green body candle. The low from here, right at a gap fill resistance. The gap on that filled. So now 80% of the time after gaps fill, we expect the other 80% of the time for prices to reverse. So for those of you who have been keeping an eye on those gap targets, chalk that one off as a fill. And again, I'm keeping that downside target in place, SPY. Now, that downside target, by the way, is 427.50. Now, one of the reasons that I'm still keeping that downside target in SPY has to do with the VIX. I made a guarantee on Wednesday. I'm going to continue announcing that guarantee right there. Let me magnify that for you. Is a 1 penny gap on the VIX. It's the smallest gap that you're going to find anywhere. But the fact is, this is a general fact that can be tracked, to the beginning of the VIX. 100% of the gaps that form on the VIX fill. I just can't tell you when. That's why I can give you the guarantee that it'll fill. I can't give you a guarantee of when. I think that will fill, and therefore we have a support level down here on the VIX I think is going to be tested. And once again, we have a positive divergence now. See, we have higher lows on the stochastic and the CCI after lower lows just showed up yesterday and today. That is a positive divergence. When was the last time that happened? Well, look to your left and you'll see here is a lower low here with a higher low on the CCI and a much higher low on the stochastic. What happened the last time we saw that? Boom. The VIX rallied tremendously, rallied $10 after that had happened. Now, I don't forecast a $10 move higher on the VIX, not just yet at least, but I am predicting that the VIX will hit that target. Let me get that data box to pop up for you. That's at 1811. Now, I'm going to mention silver, and then I want to get to some of the geopolitical news. Many of you know I have my buy order in there at 19.99. Well, if you look to the left, as I draw it to the right, you'll see that there is a gap that will be filled at $20.32. Today's low was $20.34. So we have a 2-cent gap remaining. Now, if we get a sell-off to fill that gap, and then I see the volume continue to drop or a pivot, I'm giving you my intentions ahead of time. I give our audience a chance to trade ahead of me. That way I could sleep at night feeling good that I did the right thing for our members. But I may just raise my buy limit just up a tad because I want to be 100% back into silver. Right now, I have cash more or less burning a hole in my pocket. I'm out of my silver position by 15%, and I want to get back in 100%. If I get back in on that gap fill or slightly below the gap fill point, I will be able to buy more shares of SLV. And that's what I refer to as parlaying the position. So I know a lot of people are following me on this. I don't report on it every week, but when I do, it means that's either getting close to a buy or close to a sell. And that is for silver. Now, I want to talk a little bit about something that's very serious. This is according to Equifax, one of the largest credit rating companies out there. It has recently been reported that the delinquency rate of credit card borrowers is now at a record high. Again, I find it very interesting that the markets are rallying today when you have such negative news just kind of hovering over like this black cloud over the market. That is something that is very serious because if you look at how the debt is broken down, and I'll get to that on the next slide. We have a delinquency rate that's at record highs, which is the more or less the prelude to bankruptcy. Now let's look at how the debt is structured or how it's divvied up among households across the nation. Check this one out. This is student loan debt. You see this segment right here? You look at the table up on top, and you can see where the colors are leading us, right? So student loan debt, by the way, cannot be written off in bankruptcy. And as interest rates go higher and people have a hard time making minimum payments, that interest and the minimum payments on that huge amount of debt is going to eat into the consumers and their buying power. That's very important that you keep an eye on that because debt is the enemy. When I raised my kids, I told them debt is the enemy. There's good debt, there's bad debt. You got to know which is which. But this revolving credit is absolutely bad debt. That's the chains that enslave people to debt, bankruptcy, and financial ruin. Now, you can see here the gray area is other, whatever that is. That's according to Equifax. But look at the credit card debt. Remember, this is the area where we're seeing the highest delinquency rate. That will most likely bleed into auto loans, so you'll start to see more repossessions and bank action against those who have defaulted on those loans. You understand? So this is not good for the economy. This, of course, again, this high debt leads to delinquency, which in turn leads to bankruptcy. Now, speaking of bankruptcy, I found this to be very interesting. This came out on November 8th, just 2 days ago. A third major, and that's the key word that they're using here in the industry publication, major Burger King franchisee declares bankruptcy. This is a big deal. This is not just one franchise. This is not just one restaurant. This is the third franchisee that is declaring bankruptcy. And that's 172 units. See that in the article here? 172 restaurants, could say it that way, are going out. Now the operator died in 2022, but the bankruptcy is Chapter 11 bankruptcy. That's still not good news, obviously, when you see bankruptcies like that, especially in well-known brands and restaurants such as Burger King especially. Now, what does that mean for us as an economy? Well, when you couple this with what's going on in Israel and the Gaza, you have to understand, I reported this recently to all of our members, is that Turkey more or less snubbed Blinken. You may have seen some of the headlines and maybe even some of the video and how shameful that was. But Turkey is a NATO country that has the second largest army, second to the U.S. Now, this will be the first time in history where if Turkey gets involved in this conflict and we send U.S. troops to Israel, we will basically be having two NATO countries fighting against one another. That could blow up NATO. The North Atlantic Treaty Organization was formed to keep countries in alliance, not to have opposing forces fighting against each other. So this is a disaster. Couple this with the bond market and the auction that we saw was a complete failure. That debt, that risk is going to be carried into next week. So that's only part one. Part two will be seen, and that's where I think the markets will go back into the pullback. So again, if you want to get a copy of the 7-point trading checklist, just go to stickytrades.com, sign up for the free membership. You'll stay plugged in. You'll know how to use the trading checklist. Follow along with my weekly market reports and my midweek reports, and I'll talk to you on the next video. So long.